Hey, good morning, everybody, and welcome to this Wednesday, October 11th, 2023, edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. Market seems to be back on pretty good footing again. We saw for the second straight day, all 11 sectors higher. So we are getting wide participation in this move back to the upside, which is good news. We've seen a couple of big technical moves, including the NASDAQ 100 getting back above both its 20-day EMA and its 50-day SMA. And the S&P 500, I'd provided two key resistance levels recently, one at 43.05, which was price resistance. The other was about 43.35, and that was the 20-day moving average, which was declining. Normally in downtrends, you struggle to get back through that 20-day EMA. Yesterday, the S&P 500 finished at 43.58, comfortably above its 20-day moving average. Now, we've got two key inflation reports. First out this morning, we had the September PPI this morning out. The headline number, of course, that's what everyone's going to focus on. Why? Because it was higher than expected. Came in at 0.5%. That was a little bit above the 0.3% rise that was expected. But if you strip out food and energy and you look at the core number, unchanged. Well, it rose 0.3%, but it was unchanged from the expectation. So it matched expectations. But we're not going to focus on that number because that one's not the one that's going to get us clickbaits, right? Clickbait's going to come from that 0.5% rise, which is what, when I flipped on CNBC.com on my computer, first thing that came up, you guessed it, the headline number rising 0.5%. No mention in the headline that we came in as expected on the core level, but I'll leave that alone for right now. It'll be interesting to see what happens tomorrow if the numbers are flipped and the headline CPI numbers lower than expected and the core CPI numbers a little higher than expected. Which do you think they're going to focus on? Well, we'll see. Anyway, let's go ahead and take a look at what happened yesterday. Pretty good action for the bulls. We had the Dow Jones Industrial Average rising 135 points, S&P 500 up 23, NASDAQ up 84, mid caps up 23, small caps IWM up a point or $1.97. As you look across the board, the IWM actually was the most, saw the most gain yesterday. So on a relative basis, small caps led yesterday. So that was good news. That's been a group that's been underperforming for a little while. Transports gained almost 1%, jumping 0.9%, and moving back above the 20-day moving average. So all of a sudden, things are starting to look a little bit better technically. Trust me, there's still a lot of work to do. Got many levels above to go. But things are certainly turning from where we were about a week ago, and that's welcome news. From a sector perspective, kind of an odd grouping at the top. We had utilities leading. Of course, 10-year Treasury yield coming down. That's really, in my opinion, what's been killing the utility group. So we saw a pretty big drop in the 10-year Treasury yield yesterday. We'll talk about that in a minute. And as a result, we saw some buying, a lot of buyers returning back into utilities. So utilities jumping for about the third straight day. Discretionary stocks also moving back up right at about the 20-day moving average. So just beneath the 20-day moving average. This will be a group to watch today and into the balance of the week. See if we can get this group back above that 20-day moving average. Remember, discretionary, one of the three key sectors, in my opinion, along with technology and communication services. Materials, talk about an oddball group here at the top. Utilities, discretionary, and materials. Anyway, materials up a little bit more than 1% yesterday. Also up battling the 20-day moving average, well above intraday. Came back down, closed 1 penny beneath its 20-day moving average, closing at 78.92. 20-day was 78.93. Looking at industry groups, one of the things I pointed out in the weekly market report on Monday, renewable energy had printed a reversing candle on Friday of last week, suggested maybe some short-term strength ahead. Of course, always got to watch that low in that reversing candle. Monday, renewable energy did go down a little bit, but held that prior low. Yesterday, the group exploded Renewable energy up 5.4%. Probably has a good shot, I think, here in the near term to jump up near that 20-day moving average. Maybe we go right back through it. That's going to be a level to watch, though. That sits at about 300, and we're right now at 284, so about 15, 16 bucks away. Let's call it around 6% potential upside. Another day like we had yesterday, and renewable energy will be right up against that 20-day moving average. Aluminum, also strong area of the market. So again, let's look at the industry groups. They're almost as odd as the sectors. We have renewable energy, best performing group, aluminum in that materials area, the second best. And then in the consumer discretionary area, we had hotels jumping 2.5%, back up above its 20-day moving average, trying to get back through the recent high that was established right at the end of September. If we can do that, I think hotels could be back up above 3,000 sooner rather than later. Moving on to the 10-year Treasury yield. So let's get a quick update here. Talked about the fact that Friday we had a long tail intraday move on the 10-year Treasury yield that was up above the prior high at 480. Remember, that was the day we had the jobs report come in hotter than expected. A lot of folks at the beginning of the day selling bonds as a result, expecting yields probably going to go higher, expecting the Fed maybe to be more hawkish as a result of that strong jobs report. And so early, there was a big move to the upside, but you always have to be watching for the reversal. And off of an uptrend with that failed breakout to the upside, we came back down. We closed below that prior high. Of course, the bond market was closed on Monday, so we had to wait a little bit. But what I pointed out was when you see these long tails like this, the only one really I saw looking back that looked kind of similar was after this move to the upside in late May. And you can see almost a similar kind of candle where you closed here above 380, opened maybe right around 380, intraday got up into the upper 380s and then came back down and failed on the close. 2 days later, where were we? 20-day moving average. Look at this action right here. Failed breakout on the 10-year Treasury yield. 2 days later, and a holiday in between. Where are we? 20-day moving average back to 4.58%. So this big drop, I mean, we've lost now about 30 basis points in the last 2 days that the bond market's been open. And as a result, we've seen utilities come back. We've seen the NASDAQ performing well. We've really seen across the board advance on equities as we pull back. The other thing that this does, in my view, is that with a big CPI report coming out tomorrow morning, even if it's a little hotter than expected, it's giving us room to the upside without breaking out again. Another 20, 30 basis points, if the CPI comes in hotter than expected, still would not create that breakout. So good news really on all fronts, bond market, stock market. I think that was a good start to this week for stocks. And now we've got the two big inflation reports, one now in our rear view mirror, now that the PPI has come and gone. I believe later today, watch for 2 o'clock, just double checking, but I think this is Fed minutes. Yeah, FOMC minutes are released at 2 p.m. today. So if there are any surprises, maybe we see some changes taking place around 2 o'clock, and then traders will have to position. They're going to have to decide, do they want to be in stocks? Do they want to be out of stocks? Do they want to be shorting stocks? What do they want to do ahead of this CPI report? So later today will be interesting. And then tomorrow, earnings season. We don't really get the banks, which I consider to be the kickoff to earnings season. We don't get the banks until on Friday morning. But tomorrow we will get Infosys in the morning, Fastenal in the morning. That's a industrial company. Delta Airlines. I think this is going to be an interesting one because the airlines have been hit so bad. Delta's trying to make a little bit of a rebound heading into earnings. And Delta has been one of the best performing airlines on a relative basis. So getting a glimpse into the airline group, you're going to probably get a pretty good look at one of the better ones on Thursday morning. That could set up how we might expect airlines to trade throughout this quarter. So keep an eye on Thursday morning on Delta Airlines. We got Walgreens, Boots Alliance will be reporting, Domino's Pizza. That makes me a little hungry. And commercial metals. Commercial metals is going to be an interesting one because this is a stock that actually has been performing pretty well. I think I featured this one in our EB Digest recently. So go back and take a look at that if you haven't already. All right, keep moving. Let's keep moving here. S&P 500. So there you go, back up above the 20-day moving average. The reason I think this is key, at least in the short term, now maybe it's just a one-day wonder. Maybe we'll, gap up this morning, sell off. By the way, futures are still hanging on. And actually, last time I looked, we're strengthening a little bit, even after the PPI came in hotter than expected, according to CNBC. But let's take a look at the diamonds. Right now, futures diamonds are up about 1/3 of 1%. Spider, same thing, about 1/3 of 1%. NASDAQ 100, the QQQ, up about 0.4 of 1%. And then we've got the IWM, which is up about 1/4 of 1%. All of those were a little bit lower right after the PPI report came out. They have strengthened again as we head toward the close or the market open, which will be in about 18, 19 minutes. So overall, I think the action here moving back up through the 20-day is big because it gives us more of a sense of sideways consolidation rather than a downtrend. So when you look at the long-term market, when we start the downtrend, we generally tend to really get going with force to the downside. I was looking for 4,300 back at the beginning of July or middle part of July when I said, hey, things are, looking a little bit more cautious. Let's be careful here. Mid-July through the latter part of September historically is a weak time of the year. These were all things we talked about. There were negative divergences. We saw some of the rotation turning a little bit more bearish. There were a lot of reasons to be at least cautious during the summer months. And then once we saw the market start to roll over here in early August throughout different blogs, through these YouTube shows, Trading Places Live, and through our message to members through our daily market report, what we talked about was the potential of this, being a weak period for an extended period of time. Back then, I said worst case, I thought would be 4,300 on the S&P 500. And that was basically to go back and test the breakout from the August 2022 high, which was at 4,305. So I just lengthened this chart. And if I give you this price support right here, that's kind of the level that once we broke out in June, we never really went back and tested. So from here, as we started to roll over, I said, okay, worst case, maybe we go all the way back and we test, have a little bit of a false breakdown here. And, that was a lot of folks pointed to that head and shoulder top, went down below. Don't really see the big heavy volume that you need to confirm a head and shoulders. Head and shoulders are patterns that you look for heavy volume to confirm and execute the pattern. Here in this case, the volume was just kind of moderate. This big volume day right here was actually, this was the day that this was a few days, I think, before the Fed announced. And I believe it was also option expiration day, which is normally very heavy. If you go back to June, you can see option expiration very heavy. March, very heavy. December, every third month, that's quad witching. And that's when you're going to get your heaviest volume days in the market, a lot of repositioning. So anyway, that was more related to options. And this was back here. When we actually made the breakdown and we shot lower after the Fed, the volume was actually pretty light. It was not big volume that accompanied this move to the downside. So there were a lot of folks talking head and shoulder breakdown, measurements going blah, blah, blah. Technical analysis requires more than just breakdowns. Also, I always get a little nervous with these up-sloping necklines. Down-sloping necklines to me are much more ominous because when you break a down-sloping neckline, the two lows that connect the neckline are actually going down, which means when you break that down-sloping neckline, you lose all the price support. In this case, when you have up-sloping necklines and you break down below, that first breakdown didn't take out the left side of the neckline. We haven't really lost that price support yet. And then ultimately, when we did, you can see volume not very strong to the downside. And I would argue it's been stronger on the way back up than it was on the way back on the way down. That's kind of unusual. Normally, market picks up steam and actually you see higher volume on moves to the downside because there's more panic involved. To the upside, you don't really have people panicking to buy. In fact, most folks, after the market goes down, they don't believe it. So you tend to see lighter volume on the way back up. Anyhow, it's not really what we've seen. And so I would caution against that neckline. And I would say this, you don't want to go any further to the upside if you really believe that this is a neckline, because you are right now testing. You're going back up and you're testing that neckline. So the bearish argument here is, okay, we broke down. It's a head and shoulder pattern. We're going to go a lot lower. And this rally is just simply up to test the neckline and then back down. We'll see. That's one argument. Again, I don't believe that this is a properly executed head and shoulder top. I never believed it was a head and shoulder top to begin with, but we will just kind of monitor it together over the next few days. And we'll see how this plays out. Tomorrow is certainly a day, though, even if it's short term, if there's bad news coming out with CPI tomorrow, don't be surprised by a gap down and maybe even some short term selling. We could go back down and test the lows. I don't believe we're going to, but that is certainly a possibility in this false breakdown here. I think probably would get the last sellers out of the market. All right, let's keep moving on. NASDAQ 100. You can see the NASDAQ 100 actually kind of holding its neckline, never really, and this is a downsloping neckline. Let me annotate this one. And so if we connect that low and this low, you can kind of see right on this low and this low also connects these lows. So we never actually broke down below the downsloping neckline on the NASDAQ 100. And that's been leading. And now that rates have come back down here over the last couple of days, certainly given, it's a catalyst, if you will, for higher prices on the NASDAQ. These are growth names that tend to perform much better when rates are declining, although they've held up really well in 2023, even with rates going up, which tells me one of two things. Either the market doesn't, anybody investing in these growth stocks doesn't believe rates are going to stay up for long, number one, or number two, what was my number two? I was thinking about it. Or number two, the market doesn't care about higher rates because the growth rates are going to be so strong that they'll overcome the higher interest rates. Remember, valuations aren't just about interest rates. Valuations are about growth as well. That's why a lot of times when the interest rates, when the 10-year treasury yield goes up, the stock market has a long-term history in the short term of following the 10-year treasury yield to the upside. Why? Because normally folks are getting out of bonds when the economy is strengthening. Getting out of bonds means yields go up. There is always that 100% inverse relationship. So when you've got the economy strengthening, you've got bond yields going up, money is coming out of the bond market and going into the stock market. So the stock market goes up. So these two tend to go hand in hand during periods where we're simply looking at the economic activity. Now, we know we've been in a market where there's been a lot of talk about inflation. We had a big surge in inflation, 21 to 22. I believe that's over. Inflation's been coming back down. I think the Fed's talking tough because, and I don't disagree with that strategy, because I do believe that their number one mandate is price stabilization. They do not want inflation to get away from them, but they also don't want to be fighting the ghost of inflation and killing the economy. Because when you do that, you build up inventories. And when you build up inventories in companies and they have to get rid of it, what do? They mark prices down. And you can get into this deflationary spiral, which in my opinion is way worse than inflation. So there's a balancing act that the Fed has to be very careful with here. And that's why I don't believe in this whole another interest rate hike or rates higher for longer. I think they're saying that to try to encourage less spending, to encourage the stock market to go down, or at least not to go up, because anytime the market goes up, we all feel wealthier if you're invested in the market. got 401ks, or you have investments outside of your retirement in the market. When the market goes up and you're making more money, you feel wealthier. And when you feel wealthier, you spend more. So anyhow, there's a psychological component to what the Fed does. And so I think the talk, sometimes that talk is cheap. A lot of times what the Fed says, they never end up doing. That doesn't get talked about enough on many of the media outlets like CNBC. They should go back and talk more about what the Fed says and then what they ultimately do, because many times it's not what you might expect. Anyhow, NASDAQ 100 holding really nice. I think this looks good. IWM, finally a test of the 20-day moving average. It had been almost a month since our last test. This has been a group that's been under a lot of pressure to the downside for a period of time. I'm not so sure that I'm not going to be right eventually about small caps, but I kind of gave up on them in the short term, leading, simply because they just kept lagging, not only on a closing basis, but even on my intraday analysis that I've been doing, where it was showing some strength back in June, July, where not only were we seeing gap ups, even before that, actually, back in May, we started to see a lot of rotation into small cap growth away from value. And I thought that was starting to signal some good signs for the IWM. We had a big move. We actually had a close that took out the prior close in February, and also the close back in 2022, the rise there. I can pull another longer chart up and show you that. So this peak right here was below 197. This peak was maybe right around 197. Same here. This went up above 197.5 to almost 198. So we actually had a breakout. And then this happened. And when this happened, a lot of the signals that were bullish for me on IWM all went bearish. So wasn't a great call, but hey, that happens in the market. You're not going to get everything right. If you think you're going to get everything right, you probably ought to just give up the market and go play golf or tennis or hike or whatever it is you do, because you're going to be really disappointed if you think you're always going to be right. Anyhow, I do think the IWM, there are periods of time where the IWM does lead the NASDAQ, and we saw a lot of leadership in the NASDAQ in 2023. So I'm not ruling out the IWM coming back, but it's got some things to prove. As you can see, not even back through its 20-day moving average, still way away from its 50-day moving average. And you can see on the NASDAQ, we actually have cleared both on a closing basis. So that's where things have kind of deteriorated quite a bit on that small cap index, or on this small cap ETF. Transports back above the 20-day moving average. Now, we saw this back at the end of August briefly before we resumed to move to the downside. So I say this because this looks a little similar, and usually bottoms don't get carved out like this. Normally, after you go down for a while, you get a positive divergence. If we were to go down one more time, my guess is we would probably have that positive divergence. Again, I'm not calling for the market to go back down one more time, but if CPI is much hotter than expected, maybe it's in the cards. Maybe we do go back down, test the recent lows, maybe even pierce them slightly. But I do think if we haven't bottomed already, I think any post CPI report low is going to be the bottom. And I don't think it's going to go much below the prior low, if it goes lower at all. Let's move on. First, just want to welcome everyone again to earningsbeats.com, and especially all those that are new watching on YouTube to our live stream. Really appreciate you tuning in. We do this Tuesday, Wednesday, Thursday morning, every Tuesday, Wednesday, and Thursday morning at 9 a.m. So you pretty much can check in if you want. I think we take a little different look to the market. Our view of the market, I think, is very unique. And we've got a pretty darn good track record if you go back and you follow us over the last several years. Not the last couple of months, not the last 6 months, last several years. I think we've been pretty spot on with a lot of our longer term calls, a lot of our short term calls. So again, I want to welcome everyone here. Make sure you pass along to your friends. Let friends know if they're into the stock market to check this out. One of the missions for me, there's nothing that makes me feel better than knowing that I'm helping folks manage their financial future. So just trying to educate, we're a market research, educational, and guidance platform. That's our three main pillars, if you will. This is all part of the education process doing these shows. So we really appreciate it. Later today at 10 a.m., we will have our live trading room. So our live trading rooms every Wednesday. So if you want to sign up for a 30-day free trial to our paid service, it's completely free. You have to give your credit card, but we will remind you before we are going to charge you after 30 days to let you know. We don't want you to be a paid member if you really don't want to be one. But if you'd like to come to our trading room today at 10 a.m., it's live trading room, and also the next 4 weeks, because you'll get 5 Wednesdays over the next 30 days. So you'll have 5 different Wednesdays to check out our live trading room. Make sure you sign up for our free no-cost trial. If you're just getting to know us and you're like, okay, well, don't know if I'm ready for a paid membership, we've got a free membership. And the free membership is our Earnings Beats Digest newsletter. Name and email address. That's it. No credit card. You can unsubscribe at any time. You're not going to hurt my feelings. 3 times a week newsletter, just focusing on things that are important to us at earningsbeats.com. Again, no credit card. You can unsubscribe at any time. We'd love to have you. So make sure you go over to earningsbeats.com, scroll down and sign up. By the way, anyone who is on our Earnings Beats Digest newsletter, any subscribers, if we do a free event, a live free event, we will send you instructions. We'll send you room instructions so that you can attend. And we do a lot of live free events during the year. So another reason to be subscribed is not only to receive the 3 times a week newsletter, which, by the way, is only 2 paragraphs in a chart. So it's a very simple read 3 times a week. But in addition to that, you also will be included in any of our live free educational events that we do throughout the year. So make sure you sign up there. All right, so today's chart of the day, Lamb Weston. So I thought this was interesting because Lamb Weston, LW, reported earnings last Thursday before the bell. And this is a food products company, and they blew the number out of the water. Their earnings per share, I think, came in at $1.63 versus a $1.09 estimate. $1.63 versus a $1.09. And revenues, I think, were might get this wrong, 2.6. I don't know. I'm not gonna. I know their revenue beat, and it was in I did put it in the newsletter article for this morning. But they had an easy beat on revenues, crushed earnings estimates, and you can see here was the close prior to earnings. And let me just hit inspect. I'll tell you what that was. 90.49 is where we closed on Wednesday. So then the good news comes out, and the next day we open at 99. So about a 10% increase at the opening bell. And then intraday, we got up to 101.81. We were clearing this prior high, which is, in this series of lower lows and lower highs, this is a key high. So we opened up beneath it, but traded above it intraday before coming back down and closing beneath it and printing a shooting star candle, which off of a big move like this to the upside is a reversing candle. And look at what happened the next 2 days. So this would have been Friday and then Monday. After being up at 101.81 after earnings came out, 2 days later, we went all the way back down and filled the gap to 90.49. So when I talk about filling the gap, or if you hear technicians talk about filling the gap, what that means is that something, not always, but when you have big gap ups, usually it's something, some news, some event, something that triggered a lot of buyers to flood in to the market. And of course, market makers see all this demand coming in and, pre-market action, and not many sellers. Obviously, what do you want to sell for? You're about to make a bunch of money, right? And so there's an imbalance. And so market makers determine where a stock opens based on all the demand versus the supply. And one of the things I like to watch is whether you open above resistance or below. In this case, we opened below and then intraday went above. And that is just a little bit of a red flag to be thinking during the day, because you didn't get it open above. You got some intraday action. This could be market makers trying to distribute shares for an institution that wants to get out of a stock. So you got to be careful when you get these intraday moves to the upside that take out resistance and then fail. I don't like these tails that sit above key resistance. Anyway, all the way back down, filled the gap, printed a little bit of a hammer. You could call it a doji, but it is up in the upper 1/3, a little small body. Hammer would have been more of a, maybe a little bit bigger body. The shooting star is same as a hammer, except it's upside down. So kind of flip this around, and that would be more of a hammer. But anyway, now we're trading in this trading range. And the thing that's interesting here, number one, check out the AD line, which is horrible. Also, I'm going to pull up the relative chart, and I want you to look at food products group relative to the S&P. Very, very poor industry group. So yeah, Lamb Weston's pretty good stock, but it's within a very, very bad area of the market. It's had a false breakout. Only thing I would say about a stock like this is be careful. All right, that is it for me today. Let's just go over and get a quick look at what the market is doing. And it's about what we talked about earlier. We've got Dow and the S&P both up roughly 1/3 of 1%. NASDAQ picking up a little bit, now up 1/2 of 1%, and pretty close right now to where the high was yesterday. Not quite there. It'd be nice to see another higher high. Right now, if you look at a short-term, maybe 10-minute chart, 5-day, 10-minute chart, you'll see that we've had higher highs and higher lows now going in the past few days. So I'm sure bulls would like to see that continue. And we'd like to see more and more participation of areas in the market back above 20-day moving averages, because wide participation always a good thing. It's nice to see the NASDAQ going up, but remember, those are a lot of the high market cap companies that have been carrying the market much of 2023. Be good to see some of the others, the small cap index, starting to participate as well. So keep an eye on all of that. But that's it for me. Be back here in just about 30 minutes for that live trading room session. Again, you got time. Go over to earningsbeats.com if you want to join. Make sure you sign up for a no-cost trial, and then you can come in and you can join our trading room at 10 a.m. If you have any questions, reach out to us at support@earningsbeats.com. That's both names plural, earnings beats. So support@earningsbeats.com. We will get back to you as soon as we can. Have a great day, everybody, and happy trading.